So there's a lot of news coming out over the next couple of days, over the next couple of weeks that will really gauge the direction of the stock market going forward. We have the FOMC meeting that will be happening on May 3rd. So everything that happens up until then will really significantly impact what Jerome Powell does on May 3rd, which will significantly impact the direction of the stock market for the rest of the year. So you need to be paying attention to what is going on. And we're going to discuss all of that, as well as some recessionary fears that are really brewing up and is really setting all the stock market experts in a frenzy. So without further ado, Lucy, I really want to get into this one, bro.
Yeah, so guys, just as a heads up, I think there's going to be a lot of news incoming, and we got to make sure we know what's happening. But I will say, Rel and I are on our family vacation, so he's with his family, I'm with my family, and I'm probably going to be on mute on this episode because there's a lot of background noise, as you can imagine. But go ahead, bro, share your screen, let's get into it.
For sure, most definitely. Yeah, family time, man, family time undefeated. But yeah, so like Newski, like we said, bro, a lot of news. For example, on Wednesday, April 12th, you see that we have CPI numbers coming out. And for those that don't know, those are the numbers that's telling us exactly how inflation is doing. Has it picked up? Has it gone down? So we want to definitely keep our eye on that. And also PPI, which is the producers, right? We're going to see how producers are doing when it comes to inflation as well. That comes out on Thursday. So we are really looking forward to that. Friday is retail sales as well. So there's some big news that kind of shows us some numbers that are going to tell us how inflation really is looking. Because, Newski, correct me if I'm wrong, but hasn't inflation pretty much been the biggest thing we've been looking at over the past year?
Yeah, so at the end of the day, guys, inflation's been everything we talked about for a very, very long time now. Every single time it comes out, as we talked about earlier, it's like a Super Bowl, right? It's like an NBA All-Star game. Everyone's all hyped about it. And then you see interest rates coming out, everyone's all hyped about it. But there's other things we have to be more concerned about. It's just inflation does determine a lot, which is why it holds a lot of weight. But that doesn't mean there's not other things going on. And we need you guys to make sure you pay attention, because news channels will come out in the next couple of days, next couple of weeks, and try to hype up everything like it's all good. Earnings are great for Q1, but we're about to break down why you need to make sure that you're paying close attention, because they might not be all good.
Yep, exactly. There's a lot of things going up on the back end, and you can kind of see it in the stock market pricing. The stock market, it definitely rallied, but it's been pulling back a little bit as of this recording, and I think that's because of what we're about to get into. But just really quickly, I want to show you guys. Pretty much, we always show you guys the Fed Watch tool to keep your eye on what we're projected that the Federal Reserve is going to do at their next FOMC meeting. And that meeting is once again May 3rd. So as you can see on May 3rd, what's expected for them to do is it's 66% are expecting that they're going to do a 25 basis point rate hike, which is equivalent to 0.25% of an interest rate increase on May 3rd. And only 33% believe that the Fed is going to pause on May 3rd. But it's crazy because I was watching this literally on Friday, bro. On Friday morning, before 8:30 a.m. Right? So at 8:30, we got job numbers that told us about unemployment and how it's doing. At around 8:20, this was pretty much 50-50. Literally half of the Fed futures traders thought that we were going to pause, and half thought that we were going to rate hike in May.
It's not even that, bro. Another crazy part is people thought, remember, like, I think it was just 2 or 3 weeks ago, 0.5%. That was a huge part as well that people were predicting. Now it's at 0%. So that's not even in the picture at all.
Literally, so not in the picture at all. Like, we know they're not going to do a 0.5% rate hike. That's out the water. They can't do that. They would destroy the banks. We already seen the banks have had trouble dealing with these rate hikes. So if they did 0.5%, you might as well delete the whole banking sector. Like, so now they know they can't do that, but everybody was anticipating that they would pause. And as soon as the job numbers came out, they were like, oh, nah. The Fed has to stay hawkish, which means they have to stay aggressive on rate hikes. So that shifted from 50-50 to now 66 to 33, just about, give or take. Even on Friday, this actually said 71% was anticipating a 0.25% hike. So these numbers fluctuate a little bit, but it just shows you that it's now off sides. Now everybody's pretty much anticipating 0.25%. And so now that kind of like poses the question, is like, how could the banks do, if the banks were struggling before this rate hike, now we're going to rate hike again? if the banks have to deal with that, bro, that's not looking too good for the economy when it comes to recession.
And speaking of that, right? If you go to earnings, because now this is exactly why it has a huge impact. Because as you're saying, we're gonna find out how the banks were doing in the next couple of days and next couple of weeks, really, because we have earnings coming up. And the first thing that always kicks off for earnings is the banking sector. So we have a lot of banks showing how they're going to be the biggest ones, coming out and saying we did well or we did not do well. And JP Morgan is going to be the first one that comes out, really, as you can see, and says X, Y, Z. We have to pay very close attention because obviously banks play a huge role with the interest rates. So determining how the banks are going to do is going to help us figure out how we as a actual economy are going to do, and the other large cap companies are going to do, like Microsoft, like Apple, like Amazon, all these tech companies. So that's going to be extremely interesting, and I'm going to be paying very close attention to that.
Yes, me as well, bro, because it's like, depending on what these banks say, like you said, it gauges what's going to happen for the economy. So JP Morgan's kicking it off. JP Morgan, we know that they're one of those banks that they call like too big to fail, right? They're a systematically important bank, SIB. And so if they're not looking too good, the guidance that they give, you already know what's coming for everyone else. So I'm really looking at JPM specifically on Friday because they're huge for us. And it's like, understand, guys, like if the banks are not doing well when it comes to these high interest rates, they have to tighten their lending practices. So you have to understand, y'all, like if they're not lending out loans as freely as they were before, especially regional banks. We saw Silicon Valley go under and other regional banks as well. If all the banks are tightening their lending, then that means businesses around the country can't grow as fast because they can't even get lending. That means consumers have to be strapped for cash. And so it's kind of setting up for a recession, really setting up for a recession on that end. And
now, I would even add on, right? If you think about it, obviously with the banks doing what they're doing right now, it's even more important to see how banks are holding up between what we just saw with the whole run on the banks. So that's even more important to see, are these banks sustaining themselves? Are they actually holding up? Because remember, when we see earnings, it's like a report card for these companies. We get to see exactly what's going on, like how much cash they have on hand. Is their stress testing actually going to be being used or not? Stress testing is basically testing out how banks are doing, if they're able to actually handle being in the worst situation possible you can't even imagine at all, right? That's the whole point. They make up crazy situations to imagine. If this situation happens, do you have enough cash on hand? When the earnings come out, we're able to see all this information and read through it to understand if they're in good shape or not. I'm extremely interested because BlackRock is on there, which means we need to understand how real estate's doing as well, right? Because that's a huge part of it. We need to understand how the biggest financial asset management company is doing, because if they're not doing too hot, what makes you think these other regional banks are doing? So that's another point to make on that.
Nah, definitely, bro. Definitely. I completely agree. And it's kind of like, that's why we said, y'all, like inflation is not the only worry. We talked about inflation at first, but now we want to see literally how are companies doing in this environment, because recession is the fear right now. We need to see, are we entering a recession potentially? So, even to speak on recession for a second, something that came out recently is the ISM numbers, the ISM Manufacturing Index. And a lot of people don't know what it is. So just to put it plainly, it indicates the level of demand for products by measuring the amount of ordering activity at the nation's factories. So it's pretty much showing you demand for products. But it's a good way to say it when it comes to the manufacturing side of the economy. And so those numbers, guys, the numbers we just got in March was the lowest since May of 2020. If I can recall, wasn't that the COVID time period, right?
It was. That's the crazy part, because I was just thinking, like, every single time we think we're coming out, bro, every single time it's like, oh, a little rally happens. You have to put it into perspective. Like, a rally is happening because you guys want it to happen, not because there's actual situations that allow for it to happen. There's a very, very big difference. So this right here, when you look at the facts, the lowest since May of 2020 that's just not a good sign. This is absolutely terrible.
No, it's terrible. It's showing you that, like, bro, it's showing you that literally, it's like it says, implying that the rising interest rates and growing recession fears are starting to weigh on businesses. It's pretty clear that recessionary fears are weighing on businesses right now. Like, they're seeing demand slow. And if the banks are also going to be tightening their credit, they're tightening their lending, then demand is going to slow even more over time. Like recession is starting to look super clear for the end of this year. And you guys have to understand when it comes to recessions, y'all, stocks usually bottom in the middle of a recession. They don't usually bottom before the recession comes. So if it's certain, if it's becoming more and more certain that we're entering a recession, it's pretty clear to me that, like, okay, we have not reached the bottom of the stock market quite yet. It ain't there yet. And to even speak on that, like I said, equities don't bottom when the yield curves are inverted. The yield curves have been inverted for a while. So it's pretty clear that we probably haven't bottomed yet, even with that alone.
And it's also just to add on, right? I think we spoke about this earlier, bro. Guys, like we explained to what the whole pivot thing is, right? Like when interest rates are going up, cool, that's a part of it. And then they pivot by saying we're going to pause them. Then they pivot by saying we're going to start decreasing them. We spoke about this, I think, earlier in the year. I want to say it was one of our first videos that we said this year. Usually when they stop dropping interest rates, that's when we see not the market going up. It's actually usually when the market comes back down. That's usually the bottom, like 66% of the time. So that's another thing to put into perspective.
Literally, look what Nusi just said. It. I don't even know if you knew that, but that's.
I actually didn't read that. I'm not gonna lie to you.
Yeah, literally, it says stocks don't bottom until the central banks have slashed short rates enough to drop them back below the long rates, and currently they have not slashed rates yet. So what this is saying is, after they slash rates, that's when we're eventually going to see the bottom. After that, something else to keep in mind regarding that: short-term rates, like the 2-year Treasury. So it's actually been said that stocks don't bottom until after the 2-year Treasury has peaked. Currently, the bottom that we've had so far happened in October. Those were the lows that we've seen in the stock market, the October lows. Okay, guess what has happened since then? The 2-year Treasury note has increased since then. We saw a new peak in the middle of March, around March 8th. That's when we've seen a new high reach of interest rate of the 2-year Treasury note. So with that being said, the chances are historically we have not bottomed yet in the stock market, because anytime we see new highs on the 2-year Treasury, chances are the bottom is not in yet. And those chances that I mentioned is literally, it has happened 100% of the time. We have never bottomed before the 2-year Treasury note has peaked. So the fact that we just saw a new peak happen in March shows you that there's potentially a bottom coming later on in the year.
And that's the biggest, my fault to cut you off, just really quick. If you guys think about it, that's why we wanted to make this episode where, guys, since we just showed you, right, there's going to be earnings coming out. So when you see these earnings coming out, what a lot of these people are going to do, they're going to lowball their estimates, because that's what they want to do. They want to show a rally happening. So people are going to start lowballing their estimates. And then when these companies beat their estimates, a lot of these news channels are going to come out and say, oh, this is great. Everything's going well. We're doing fine. But that's not, we're clearly not doing fine. If you're actually looking at the data, we're not doing fine. So don't fall into the trap of going and getting involved in the rallying market when there's nothing to actually be involved in, rather than just sitting there and understanding what's truly occurring. I think that's the biggest piece.
Yeah, because like we talked about the last episode, for example, bro, like when you're looking at what this rally even consisted of, bro, it's been really a rally based on a handful of big tech stocks. We're talking about the biggest names too. We're talking about the Apples, the Microsoft, the Netflix, the Metas, the Teslas, right? Those companies have hit crazy numbers. We're talking about Nvidia being up over 80%, Meta being up over 70%, Apple being up like 27%, and bro, these numbers are ridiculous. And that's
in the last 3 months, guys. This is not in the year. This is in the last 3 months.
Literally in the last 3 months, they hit these numbers. That's crazy. The rest of the stock market did not follow. Believe me, if you look at the rest of the companies in the stock market, they had a rally in January and they all gave back all those gains. All them stocks came back down except big tech. That's why the S&P is only up about 6%. Meanwhile, you see Apple up 27 and Nvidia up 80 something percent, because they're holding up the S&P. But the minute those big tech stocks come back down to size, because they're overvalued right now, the stock market is going to really, really suffer.
And the only reason, guys, we just take a step back and think about it, the only reason why they were going up is because a lot of people were saying that we're going to stop interest rate hikes, we're going to put a pause on them, and then we're going to start decreasing as of May and June. But I mean, as you just saw, we're actually going to continue increasing because we cannot stop increasing the rates. So when that news does come out, and it most likely is going to happen, even in June, when you see what's going to happen, right? It's like it doesn't look too high. Like it doesn't look like, oh, we're just going to start decreasing. Remember, that's why everything that just occurred in the last 3 months occurred, because there was news coming out that we're going to start decreasing in June. I don't think that's going to happen.
And look how the numbers have shifted. A month ago, only 31% thought that we would be at a 500, between 500 and 525 basis points. But now it shows that 70% thinks that we're going to pause right there. We're still in June. 70% of futures traders are saying that we're going to be stuck at 5% interest rate, between 5 and 25%. So it kind of shows you that they're going to pause right there, which is keeping rates high. And if rates remain high like that and they don't get slashed like everybody was initially anticipating, then it pretty much shows y'all that, like, all right, we're going to actually have to potentially enter a recession, because companies are not going to do well under these conditions. And we're probably going to see that in Q1 earnings. If not, definitely Q2 earnings is going to show that these high interest rates are impacting these companies really bad. And we already see it all throughout the numbers. The economic numbers is showing you, like, yeah, demand is waning. And so, recession is looking pretty clear for us, y'all. It's most likely coming, and stocks do not do well. Stocks usually bottom in the middle of a recession. So to me, I think this rally, and one thing I wanted to say before we close too, guys, understand that there was a stat that showed that 6 months after bottom, so let's say the bottom was in October, right? It's been 6 months since then. We've been up about 10% off of the lows. This will be the weakest bounce we've ever had. The weakest bounce we've ever had 6 months after a bottom in all time history. Typically, after we bottom, 6 months post bottom, bro, we're up way higher than like 10%. Way higher.
We can't even fight back the right way.
Literally.
And everyone's still getting hyped about it. And that's the fact. I don't mean to laugh or nothing, but it's just kind of sad that when you look at mainstream media, they could dictate how exactly you guys want to think about everything. And that's why it's very important to pay close attention to actual numbers. Like, we're not even fighting back the right way, y'all. Like, that's just pathetic. Come on, man.
Come on, we can't even fight back. That's a fact, bro. So I just have to be with it and just keep your eyes not just on inflation, because it is pretty clear. Inflation seems to continue to come down, although gas prices may pick up after OPEC already cut production. So gas prices might start to pick up, which might spike inflation, which is even worse, because we're going to have high inflation with recession. Horrible. But keep your eyes on recessionary numbers. Try to keep your eye on recession, guys, because that's the key right now. Recession.
Yeah, and that's a fact. And I think everything over here is going to be very important to pay attention to. So make sure you are paying very close attention to the actual earnings, not the news, the actual earnings, to let you know what these companies are truly doing. But that wraps up this episode. If you like what you heard and you're still watching, thank you. We appreciate you. Please make sure to like, comment, and subscribe to the channel. Plus, hit that little notification bell, because we drop
2 videos a week.
And you don't want to miss them. We hope you enjoyed Easter. We hope you enjoyed your family time. But we will catch you on Wednesday. Until then, peace.
Peace.
Soundstripe.